All right, Macro Shock Nation, buckle up. Because right now, Washington, D.C. isn't just playing political games, it's actively slamming the brakes on the U.S. economy. The federal government is officially shut down, and the real question on everyone's mind is, how long until this political stalemate turns into a full-blown market meltdown? As you know, the U.S. federal government officially shut down at midnight on October 1st after Congress failed to agree on a fiscal year 2026 budget or even a temporary continuing resolution. This isn't just some abstract political squabble. It means non-essential federal services have halted, forcing hundreds of thousands of federal employees to be furloughed or work without pay. We're talking about roughly 750,000 federal workers who could be impacted each day this impasse continues. Mainstream media outlets are reporting widespread disruptions. Non-essential services are at a standstill, national parks are closed, and critical research funding is on hold. Even crucial economic data like the U.S. Jobs Report and the Consumer Price Index (CPI) report are being delayed, leaving investors and the Federal Reserve operating a little bit blind. The Federal Aviation Administration (FAA) is reporting staffing issues at major airports, leading to anticipated travel delays, and unions are warning the situation will only worsen, potentially impacting holiday travel plans. Negotiations in Congress remain stalled amid partisan disputes with no immediate resolution in sight. This standoff is being described as unique, with both major parties seemingly seeing political upside in refusing to compromise. Now, let's get into what this means for your portfolio, because the market is already trying to price in the duration and severity of this shutdown. I've been watching Polymarket, the prediction market where traders put their money where their mouth is, and the sentiment is clear. Confidence in a quick resolution is waning. As of today, October 12, 2025, Polymarket traders are heavily betting on a prolonged shutdown. The odds of the shutdown lasting more than 30 days have risen to 37%. Furthermore, a significant 70% probability exists that the shutdown will last until October 15th or even later. This reflects growing skepticism about a fast resolution to the federal government funding debates. Let's break this down into three distinct scenarios, anchored by these probabilities and our SPY technical levels. Base case, prolonged shutdown, 65% probability. This scenario is largely aligned with Polymarket's current sentiment, reflecting a shutdown lasting well beyond 2 weeks, potentially stretching towards or even past 30 days. Expect continued pressure and elevated volatility. Historically, brief shutdowns have had minimal impact, but a prolonged one, especially in an economy already vulnerable, could cause a significant correction. During the 2018-2019 shutdown, the S&P 500 corrected by 13% in the 12 preceding days. The delay in crucial economic data, jobs report, CPI, will blind the Federal Reserve, potentially impacting their decision-making on interest rates and adding to market uncertainty. We could see investors flocking towards safe haven assets. Specific market sectors. Government contractors, defense, IT services. These sectors will be hit hard. Companies relying on federal contracts for revenue will see delays or even cancellations of projects and payments. Stocks like Lockheed Martin, Raytheon Technologies, RTX, and IT service providers like Booz Allen Hamilton could experience significant declines due to uncertainty in government spending and potential project freezes. Travel and leisure. Expect significant disruption. National parks are closed, and airport staffing shortages are already causing delays. Airlines like United Airlines (UAL) and Southwest Airlines (LUV), as well as hotel chains, could see reduced demand and operational headaches, especially heading into holiday travel. Healthcare. With 40% of Health and Human Services (HHS) staff furloughed, CDC disease surveillance is disrupted, and NIH clinical trials and grant-making are on hold. This could negatively impact healthcare innovation and the broader sector. Stocks like United Health Group (UNH), while diversified, could still face indirect headwinds from broader economic slowdown and reduced government health program functions. 2. Financials. Delayed Treasury auctions and general economic uncertainty could put pressure on interest rates and bond markets. Banks like JP Morgan Chase, JPM, and Bank of America, BAC, might see reduced lending activity and increased credit risk if the shutdown severely impacts consumer confidence and small businesses. 3. Major stocks. Beyond the sector-specific examples, companies with significant government contracts or exposure to federal regulatory processes, such as major cloud providers like Amazon, AWS has government contracts, and Microsoft, MSFT, Azure government, could also see impacts on their government revenue streams. B. Bull case. Swift resolution, 15% probability. This scenario suggests a resolution within the next few days to a week, despite the current Polymarket odds leaning towards a longer shutdown. This would require a sudden breakthrough in congressional negotiations. 1. A swift resolution would likely trigger a relief rally. Markets tend to bounce back quickly from short shutdowns, as the economic impact is often reversible. We could see a strong rebound in broader indices as uncertainty subsides. 2. Specific market sectors. 1. Government contractors. Would see an immediate uptick as projects resume and payments flow. 2. Travel and leisure. Recovery in travel bookings and reduced operational disruptions. 3. Financials. Increased confidence could lead to a rally in financial stocks. 4. Major stocks. Stocks across the board would benefit, especially those that were oversold due to shutdown fears. C. Bear case. Extended damage in shutdown, 20% probability. This scenario, while less likely than the base case, according to Polymarket's 37% for 30-plus days, implies a shutdown significantly longer than 30 days, possibly extending for weeks or even months, leading to more permanent economic damage. The average expected duration on Kalshi, a similar platform, is 24.7 days, and Polymarket shows a 37% chance of lasting 30-plus days. This would be catastrophic. Goldman Sachs estimates a prolonged shutdown could reduce annualized GDP growth by 0.15 percentage points in Q4, with a permanent loss of GDP. We'd likely see a significant market crash, potentially worse than the 13% correction seen in 2018-2019. Consumer sentiment would plummet, and the risk of a recession would dramatically increase. International investors could continue reallocating away from the U.S. Specific market sectors. All sectors. Nearly all sectors would face severe headwinds. Consumer spending, which drives 70% of GDP, would suffer significantly. Small businesses face immense cash flow crunches due to delayed SBA loans and reduced consumer activity. Real estate, mortgage processing, and housing market activity could grind to a halt. Major stocks, even resilient companies, would struggle in a severely contracting economy. Defensive stocks might fare relatively better, but widespread declines would be expected. All right, so what's Dave doing with all this? Given the Polymarket odds and the ongoing stalemate, my take is one of extreme caution, but with an eye for opportunity. The probability of a prolonged shutdown is too high to ignore, and the economic ripple effects are already being felt, with jobless claims increasing. Looking at the SPY technical analysis, we're at a critical juncture. SPY is currently on key support after a pullback. This 672 level is absolutely crucial. If SPY can maintain above 672, we might still see an uptrend resume if a swift resolution emerges, our bull case. However, with the current shutdown dragging on and the Polymarket odds leaning towards extension, the downside risk is very real. If SPY breaks down further, our next support levels are 635 and then 610. These aren't just arbitrary numbers. They represent psychological and technical barriers where buying interest might emerge, but a sustained break below 635 would signal significant bearish momentum, aligning with our base case or even bear case scenarios. For me, I'm not looking to buy the dip blindly here. Instead, I'm holding a higher cash position than usual and, critically, reevaluating my sector exposures. I'm trimming positions in highly government-dependent sectors and those sensitive to consumer discretionary spending. I'm also looking at defensive plays and potentially adding to positions that tend to perform well in uncertain times, or those with very strong international revenue streams, less exposed to U.S. government gridlock. I'm watching that 672 level on SPY like a hawk, and I have alerts set for 635 and 610. A breakdown below 635 would be a serious warning sign, prompting me to de-risk even further. What are your thoughts on this government shutdown and its market impact? Are you bullish, bearish, or somewhere in between? Let me know your take in the comments below. And if you're getting value from this analysis, do me a favor, smash that like button, share this video, and if you haven't already, hit that subscribe button and ring the notification bell so you don't miss our next macro shock episode. Remember, this is not financial advice, just my analysis and opinion as a retail investor. Always do your own thorough research and consult with a qualified financial advisor before making any investment decisions. Investing in the stock market involves risk, and you could lose money.